Hey everyone, this is Hunter Satterfield, the Chief Investment Officer and a partner here at Kane Waters and Associates. As always, I am joined by one of my fellow partners and the head of our investment committee, Brian Bortz, and then also Brad Sanders, the Managing Director of Tectonic Advisors. And this is your March monthly update. For the month of March, the S&P 500 was up 3.7%. Global stocks were up 2%. Domestic bonds were down 2.8%, and global bonds were down 3.1%. So, as always, Brad, I would love to start with you. And obviously, those numbers are quite noticeable with stocks being up, rather, big during the month and what we would call a monthly movement for sure, and bonds being down, during the same time frame. So, can you kind of give a little bit of a background on what is happening and what happened in the bond market specifically in March?
Yeah, well, notably the Fed raised rates early in the month, but that was expected. I think the follow-on was Powell's comments to that saying, there's a potential they could hike 50 basis points in May. That really got the 10-year bond up a little higher. And then we've continued to see inflation numbers be higher than anticipated. Our inflation view was that we were going to start to see inflation moderate by the summer. We still believe that's going to happen, but we don't think it's going to moderate as much because of the situation in the Ukraine putting pressure on commodity prices, mostly oil, and then we're going to start to see some food cost inflation and wheat and some other things like that. That's going to offset a lot of the normalization in inflation that we were expecting. What we are seeing in the bond market is just reaction to Fed speak. Today the services numbers came out, and inflation was a little bit higher than expected, and the 10 years up, 0.1% today to 2.54. That's a huge move for the 10-year. So we're starting to see that number settle down a little bit, but it's super volatile. And that's driving a lot of the action in the bond market. And what it's causing is a liquidity problem. We've seen this, we saw this, really on display when COVID hit, but all that happened so quickly. I don't think most market participants noticed, where you had corporate bonds down 20% in like 3 days or something like that in the March of 2020 period, about 2 years ago. We've seen some similar action. Now it's not as violent, but what you're starting to see is people sell off big ETFs like the LQD, and it causes liquidity mismatches. And what that means is when you have the LQD, if you look through their portfolio, it's supposed to mirror kind of the overall investment grade corporate market, right? But they can't own every issue. There's a finite number of bonds. A company issues $1 million worth of bonds. It's not like the ETF can go buy, keep buying those as money comes in. They have to find other things and other proxies. They use the derivatives market a lot. And when you have these big violent swings, it causes the ETF selling pressure to bleed into everything else in the market. And usually what happens and what we've seen this time is the buyers step away. So on top of the action in the rates market, which hasn't been terribly unexpected, it's just been a little quicker than we expected. You're seeing that liquidity pressure coming in the form of market participants bailing out of indexed products, and it's putting, selling pressure on everything and causing prices to be lowered. That can abate relatively easily. So if you're looking at your bond portfolio and it's keeping you up at night, just know that liquidity component, once everything can kind of settle down and we can get range bound, that liquidity component typically eases very quickly. And, a lot of those, bad returns we've seen in March and some in January can come back to you relatively quickly. It's not enough to get us positive for the year or anything. I don't want anybody getting that impression, but this isn't the environment where you want to be like punting your bonds and like dumping them, because we have seen a liquidity problem right now.
Yeah, that's helpful. And I think that, also we talk to clients that, bonds are, sort of that, smooth and steady part of the portfolio. And while this is a bigger move in bonds, historically, that's still going to be a smooth and steady part of the portfolio. It provides kind of the liquidity that you need if we've got to rebalance or whatever else it is. So
yeah,
super helpful to hear from you.
Real quick, I normally don't jump back on you, but I should have mentioned a lot of the fears in the bond market when you see moves like this. We don't have any credit problems right now. Okay, so when you start thinking back to like 2008, that was credit and problems with actual companies going bankrupt. That is a very, infinitesimally small percentage of what's going on right now. So that's kind of off the table. Those are when you start to get into really bad issues. We're not in that. This is all rate based.
No, I'm glad you did. I was actually going to ask you that very question when I was talking about it being a smoother part of your portfolio and whether or not there were potentially credit, default issues ahead of us. But it's good for you to kind of comment on that. So thank you for that. Brian, let me come over to you and kind of, we're here now, we're through the first quarter of the year. Obviously you and I are continuing to have conversations with clients who are nervous and concerned and things like that. I mean, from, the investment committee of CWA and our philosophy on how we try to position clients, for the long term. Can you talk a little bit about, how that investment philosophy fits in a world that we're sort of going through here with this first quarter?
Yeah. Thanks, Hunter. I appreciate that. Last month in this very broadcast, what we said was the stock market is not the economy. And we have a very volatile stock market, but yet a growing economy. And, businesses are having a really hard time continuing to grow because they're struggling trying to find staff. I mean, airline companies can't find staff. Go to a restaurant, you can't get, a table, even though there's a lot of them open, because you can't get them staffed. Dental offices can't get staffed. CPA firms can't get staffed. So there's a lot of people who thought this great resignation was going to be great, and it really wasn't all that great. And so we have a growing economy, and these businesses are struggling to keep up with their growth. And you look at pundits, you look at people who most people think they know what they're talking about. You look at JP Morgans of the world, the Morgan Stanleys of the world, who are saying that the bear market run, that the bear market rally is over, and now things are going to turn down. Then you look at an article like today from the Wall Street Journal that says, hey, there's market indicators that say that we're headed for another bull market run. The point is, there's these guys who are supposed to be experts that are trying to predict a direction, not really even how much of a direction, just which direction, and they're being polar opposite of each other. And so to answer your question, Hunter, we don't spend time trying to predict. We have a investment philosophy that is through multiple cycles, tries to reduce the volatility and tries to smooth out all of these problems that are going on in the world so that they don't affect our clients' wealth. And so really that's the message that we've been talking to our clients about, and what we've talked about, as you know, on investment committee as well. So that's the message. Don't try to predict what's going to happen in the future. Have a long-term plan that regardless of what happens, you guys are going to be okay.
Yeah, super helpful. Thank you. And thank you both for some perspective on what's going on through the first quarter. I'm sure next month will be another interesting one to kind of talk about. So we will be back in front of y'all at the end of April. Thank you so much.